Thanks again for joining us for the monthly macro monitor for February 2019. And boy, have we had a lot of things happen since we saw you last time. And so I want to bring Joe Calhoun in, who always gives us a lot of perspective on what's going on. And Joe, one of the things in this latest report that you wrote, I want you to talk about normalcy. That was a great opening to this month's report.
Thanks, Bob. I knew I wanted to use that phrase, a return to normalcy. I've been trying to, I've said a couple of times, and I think that, the Fed, Jerome Powell, has talked about returning monetary policy to normal. And my feeling is that if they return monetary policy to normal, well, everything else will return to normal too. And I think that, the last, not quite decade, but something like that since the crisis in 2008, we have had some things that were not quote unquote normal, the Fed expanding their balance sheet as they did and so forth. It seems like it's unique. So I knew this phrase, a return to normalcy. I'd heard it before, but I knew it was from some politician in the 1920s. I thought it was actually Calvin Coolidge, but it wasn't. It was a guy named Warren Harding. Harding was the guy who replaced Wilson after World War I. So he was elected in 1920, and that was his campaign slogan in 1920. And the more I read about this campaign and about the man behind it, Mr. Harding, the more I saw a parallel between him and our current president, Donald Trump. Now, it's not a very flattering, parallel, let me say. Mr. Harding was not known as the most ethical guy in the world. But again, the point is that the parallels are there. Everybody always thinks that whatever time we're in is unique. Oh, well, nobody's ever gone through this before. I'm just unique. It's a unique time, and we've never had this before. And it's usually not true. Listen, I love history, Bob, and I think that there's that old saying about, if you don't know history, you're doomed to repeat it. Well, unfortunately, maybe it's the education system or something, but folks don't know history. So yeah, there's not a whole lot new under the sun, and today's world is not all that new either.
And I would encourage everybody to go to the report. We're going to give you that link at the end of this video, and you can go there. But you need to read that because the parallels are pretty incredible. One of the things you also talked about in there was QE. And in our lifetime, we've never seen QE until, 5-10 years ago. But that's not new either, is it?
No, again, nothing new under the sun. Everybody thinks that I hear this all the time. Well, we've never done this before. We're coming out of quantitative easing. We've never done this before. We don't know what to expect. Well, yeah, we have. Before the Great Depression in the 1920s, the Fed's balance sheet was about 5% of GDP, which, by the way, is about what it was before the Great Financial Crisis of 2008. So the Great Depression comes along, and World War II starts in 1941. So 1940, the Fed's balance sheet peaked at 23% of GDP. So I'm going to ask you a leading question here, Bob. I'm going to be an attorney and probably would get scolded by a judge for this. But what do you think the Fed's current balance sheet peaked at in this most current cycle, given the fact that it peaked at 23% in 1940? So where do you think this one peaked?
Well, if we're going under the assumption that everything cycles again, I'm going to say 23%.
Yeah, 23%. That's amazingly enough. In this cycle, we did peak right around 23%. It was actually 23.3 or something like that, whatever the number was, but it's close enough for government work. And so then by 1946, we get through the war. The economy has grown somewhat artificially, I suppose, because of government spending, but it doesn't matter. You get to 1946, and the Fed's balance sheet is 20% of GDP. And I think there was this expectation that, the Fed and Treasury worked a lot closer together back then than they do today. And it was actually an accord between them in 1951 that kind of granted the Fed its independence. But regardless, so we've shrunk the balance sheet a little bit. But here's a question. Everybody seemed to think, or a statement, I guess, everybody seems to think, Jerome Powell included, I think, that they're going to shrink this balance sheet today from $4.5 trillion where it peaked, 23% of GDP, back to where it was, or somewhere closer to where it was, and they're going to do it quickly. Well, I don't know exactly what the thinking was back in 1946, but my guess is that they probably thought something similar. So here's your next question of the day, Bob. A little quiz. When do you think they got back to 5% of GDP?
Well, if I had to think about it, I'm just going to go with 20 years.
Yeah, not quite. It's just not long enough. It actually didn't get back to 5% of GDP till the early 1980s, almost 40 years after the fact, after the peak, 40 years after the peak before they got back to where they were before the crisis of the Great Depression. So,
Well, the thing that interests me about that is if you look at interest rates, it's been 40 years since the peak to what we think is the trough right now. So there's a correlation there.
yeah, I'm not sure what it is about 40 years. The wandering in the desert for 40 years and the Bible and 40 years cycles and balance sheet adjustments for the Fed. I'm not sure what's up with that, but this is something we've been thinking about here a lot. My career started in 1991 as a professional, but I've been in the market since the early 80s. And really, my investing career, investing my own money and other people's money, started in really right about the time interest rates peaked in the early 80s. So my entire investing lifetime has been a period where inflation has been falling and interest rates have been falling. And I think, based on this balance sheet explanation and so forth, that we are in a trough similar to what we were in the early 50s. And that now we're going to see rising inflation and rising interest rates for the rest of my career. If I'm right about that, it's going to mean a much different environment to invest in than anybody in the business or anybody investing their own money has become accustomed to over the last 40 years. It's going to be very different.
Well, let's talk short term for a minute about interest rates, because the Fed over the last couple of years has raised rates. I mean, nothing big, generally a quarter point at a time. And now then, there's the theory in there that because of what happened in the fourth quarter of 18, that the Fed's going to hold off at least till the second half of this year before they raise rates again. What do you think?
Well, me, I don't like to predict stuff because I'm not any good at it. But it does seem that the Fed seems like they're kind of on hold here based on the number of speeches that people have given, essentially saying that they don't see any reason to raise rates. Look, we've seen inflation expectations have fallen pretty dramatically. I mean, everybody talks about, oh, well, Powell blinked. The stock market went down and he blinked. He's going to stop because the stock market went down. Well, I'm not sure that's really it. Powell, I think, is a very pragmatic guy, and I think he's looking at things like inflation expectations. Well, not only did the stock market fall in the fourth quarter, but inflation expectations fell pretty dramatically because oil went down. So I don't think it's really necessarily the stock market. I think it's just that inflation expectations have fallen, and there's really no reason to raise rates. If you're at your target for inflation and now expectations for future inflation are falling, why would you keep hiking rates? So I don't know when or if they're going to hike rates again. Are they done for the year? Are they done for this cycle? I don't know the answer to any of those things.
Well, what about growth? About this time last year, maybe it was the second quarter of last year, growth popped up to about 3.5% GDP. And now then it seems like the economy is slowing a little bit more. Are we headed back to the new old normal or the old new normal or whatever we want to call it in that 2 to 2.5% range?
Well, like that's been my expectation all along because the tax cuts were not, I think, something that was going to provide a permanent change to growth. Ultimately, investment in the economy is not driven by tax rates. Ultimately, investment in the economy is driven by expectations for future growth. And right now, we just don't have that, any expectations for higher growth. Look, there's two things that affected growth in the second, third, and probably even the fourth quarter. We don't have numbers on yet, but two things. One was the tax cut, and you did get some burst of activity from that and from the increased spending. Remember we expanded the deficit to over $1 trillion last year. So extra government spending, obviously from the way GDP is calculated, it does show up in the GDP numbers. The other thing that we had was because of all the trade and tariff talk, we had front running of those tariffs. When people think a tax is going to go up, they act before the tax goes up. And a tariff, I don't care what anybody tells you, a tariff is a tax. And so what's been happening for the last couple of quarters is that companies and individuals have been buying things where they expect the tariff to rise. Remember, until December when Trump and Xi met in Argentina for the G7 meeting, or G20 meeting or G whatever meeting. I remember if it was G7 or G20. I can never keep that straight. But anyway, they met, and there was kind of this agreement that they were going to negotiate and so forth, and that Trump said, we'll hold off on raising the tariffs in January. Because remember, the original deadline was they were going to, on January 1, tariffs were going to go up again. So that got put off. So what had been happening up until then, though, is companies and individuals were buying things where they expected those tariffs to go up in January. They bought things in third quarter and fourth quarter that they wouldn't have bought otherwise. So we got a pulling forward of activity into the third and fourth quarters, I think. And we see that in inventory numbers, too. We saw inventory to sales ratios did rise. Absolute inventories did rise. And so we know that happened. So my point is that was artificial. So even if you resolve the trade stuff, it doesn't mean the trade's going to automatically pick up. In fact, I think it'll do the opposite. A lot of, since that activity got pulled forward, now companies are going to have inventory that they need to work down. So if we come to a deal with China and trade in the first quarter, say, by the March deadline, I don't know that it means anything positive necessarily for the short-term growth of the economy. But the bottom line is, look, growth is about workforce growth and about productivity growth. And you're not going to raise it above whatever when you add those two things together, you're not going to raise it much above that for any length of time except some short burst. So productivity is growing at a couple of percent, and that's being generous, by the way. And in good quarters, it grows at 2, probably more like 1 or 1.5. And population growth is well less than 1%. So you're talking about 2%, maybe 2.5. That's the trend growth. It's not changing, and changing the tax code didn't change that. So we're going right back where we were. What I'm a little bit worried about is oftentimes, economies don't just go to a point. It's likely we'll overshoot. If we overshot and went up to 3.5, we might overshoot and go down to 1.5. But that's okay. We can live with that as long as it doesn't go to 0 or some negative number.
Well, there are a couple of weak spots in the economy. One being housing, and the other being shale. You get any real read on that this month?
Well, no, not really. I mean, housing obviously has continued to look poorly, but we've had the government shutdown meant that we didn't get some numbers. Construction figures were one of them, actually, and so we didn't get a lot of information. But we've had some information. Existing home sales were down. I don't think there's any reason to believe that housing has suddenly gotten better. Put it that way. The shale stuff, look. I think that the point with housing and shale is that, and what the point I've tried to make here is that I don't think, even if you add them together, I'm not sure they're big enough. If they fall back, I'm not sure they're big enough to cause a recession. Remember back when the previous shale bust in 2015, 16, I don't know how many commentaries I wrote where I have no idea if this is going to be enough to push us into recession, but I don't think so, because I didn't know. And ultimately it got pretty close. Growth went to 0 or real close to 0 one quarter, but we never went negative. So look, real construction, or put it differently, residential investment. Let's use the GDP vernacular. Residential investment in the U.S. economy in the 80s and 90s was 4 to 5% of GDP. And it stayed in that range almost the entire time. And then we got the housing bubble. By 2006, it ran up to about 6% of GDP. Then you had the crash, and it fell back to 2.5. Well, our recovery is only taking a little above 3. So it's not anywhere close to where it was prior to that 2008 bust. So it's just not as big a part of the economy. So even if it pulls back, it's just not going to have that big of an impact. And the shale stuff, it seems like that the previous bust in 2015, 16 shook out a lot of the weak players. There's a lot of companies that went bankrupt. The ones that survived still had to borrow money from banks in order to go out and drill new wells. And to do that, the banks said, well, you're going to have to hedge your production. So almost all these guys have their production hedged out a couple of years at a profitable level. So I don't think you're going to see a lot of stress there. And I think that's why we didn't see credit spreads widen that much more. So look, I think it depends probably on what the dollar does. But if oil prices stabilize here, or if they go back up, then I think we're okay.
Well, industrial production took a hit because of the weather, which sounds a little strange, but it's been pretty mild winter in a lot of places. And what happened there?
Well, it was in December. I mean, yeah, utility production was down over 6% in December because it was a fairly warm December for whatever reason. Now, I think we're making up for it this month. I think you're pretty chilly up there in Nashville. And my daughter up in Boston, they had some days that were in negative numbers there for a while, for a couple of days last week. So, and I saw Chicago is just going into the deep freeze this week. So we'll probably make it up. But, I think a lot of people don't appreciate how much volatility you get in those industrial production numbers just because of the change in utility output. 6% swing in 1 month is pretty darn big.
Well, I mean, here in Nashville, it was 60 over the weekend. It's 11 today, going to be 60 by next weekend. It's all over the board.
Yeah, climate change, I guess. I I don't know whether to expect a new ice age or if I should break out the tanning butter.
Hey, let's talk about CFNAI. In December, the number we got was a 0.22. Preliminary numbers this time around 0.27. What's that pointing to?
Well, this is one of our main indicators. CFNAI is this 85 different indicators kind of aggregated together, and they use this a +1 to a -1, essentially, is the range of this thing. And so when it's at 0, it means you're growing at trend, which we've just talked about is around 2.5%. When you're at +1, you're really cooking and things are great. And when you're at -1, you're probably in recession. So 0.22, what does that say? It says we're slightly above trend. That's all it says. Now, the December number at 0.22, that was before the government shutdown, so we had all the numbers. The number that just came out yesterday, and I said 0.27, I hope that's right, because I can't remember off the top of my head exactly what the number was. I know it was up a little bit, put it that way. They had 45 of the 85 indicators. Now, you think, oh, gosh, that's not very many. Well, at this point in the month, that we would normally only have 50, and they estimate the rest. So having 45 of the 50 means we had most of them. Some of the ones we're missing were negative, though. So construction is going to be negative probably. So I don't know. But the point is we're still growing slightly above trend. That's where we've been. It hasn't changed. I don't know why people are surprised.
Well, you've been saying that for a long time, slightly above trend, so no surprise here.
It's no surprise at all.
Durable goods orders for December. That's reported. That didn't look good, especially capital goods. But if we go a little further back into November, there was a pretty decent revision. So it looks like we're all over the board on durable too.
Well, durable goods is a very, very volatile number, but it's still growing. It's still moving in the right direction. It hasn't changed all that much. The capital goods numbers do worry me. They were negative again this month, but like you said, the previous month was revised significantly higher. Capital goods orders are really important. What we were talking about before about economic growth is about productivity growth and workforce growth. Well, you don't get productivity growth without investment. You don't get investment without buying capital goods. So we watch those numbers pretty close. Look, it's been kind of flat over the last few months, up and down, up and down, up and down. You end up with a flat number. So, yeah, it worries me some, but it's not that worrisome. Like I said, the overall trend, year-over-year trend, is still a positive number, and it's not a great number, but it's consistent with what we see in the CFNAI.
Employment seems to be moving on at kind of a decent rate, but talk to me about the quits rate, about the challenger job cuts, and about hourly earnings.
Yeah, we watch a lot of different indicators with the employment market because it is very important. Although not in relation to inflation, by the way. I'm not a big believer in the Phillips curve, mostly because it doesn't work. I don't know why the Fed thinks so much of it, but anyway. The quits rate, it comes from the JOLTS report, which is the job openings and labor turnover survey. JOLTS. Quits rate. Quits rate is important, or the quits rate is important because it tells you the confidence that people have. If somebody's willing to quit their job before they've got another one, well, that's really saying something. They think it's going to be easy to go get a new one. So the quits rate we watch pretty closely. It did fall. That's the first time we've fallen in a while. Last month. And it was a pretty big fall, but it's still moving in the right direction, but it looks like it's peaking to me. Challenger job cut report is, again, it's not, Challenger looks at layoffs from large companies. So it's not indicative of the entire economy, but it does say something. And those Challenger job cut numbers are up significantly over last year. I can't remember the number. I think it was about 35% over last year. And so it's a big change. We had some big companies lay off a lot of people. Verizon laid off a bunch of people. Wells Fargo laid off a bunch of people. Ford, some of the automakers are laying, or GM is laying off people. So, you know, that could be a positive in the sense that we're getting more productive and they don't need those people. And it may be negative that sales are not that great and we need to get rid of some people. We don't really know, but less people working is generally not what we're looking for.
Well, the last numbers I heard, and it's been a little while, weren't we still up around 17 million in auto sales in the U.S., which is not quite the top end?
Yeah, we're right around 17 million. And look, this is typical too. We've talked about this before, Bob. You know, you go into recession, 2008, we went down under 10 million. But what happens in these cycles is you peak around 17 million, at least it's the last few cycles. It's going to change, obviously, as population changes, but up around 17 million and just go sideways for the next rest of the cycle. It's hard to get above that 17 million rate. That just seems to be a top. So we're still up there near the top, but it's going sideways. It's doing exactly what it did in the last cycle. So again, nothing unusual.
Well, let's talk about bond yields. And in fact, we took some profits on the longer end in our portfolios, kind of tighten things up, shorten them up a little bit.
Yeah, early in the month we did, January 7th, we took some money off the table. We had been had a fairly long duration portfolio when rates got up to 3.25, which, as you know, we talked about that last year as being a peak. I'm still trying to break my arm, pat myself on the back for that one. 3.248 was the high, and I said it would be 3.25. I don't know if I could have got any closer, 0.02%. But anyway, by the way, that's pure luck, folks. I don't have a crystal ball. So 3.25, we had extended duration and bought some longer term bonds. And so when we got down under 270, that's pretty good capital gain. And we took some profits. We felt like that was kind of as far as it was going to go. I don't think you're going to see inflation expectations fall a lot from here because the dollar seems to have peaked. Inflation seems like it's probably hitting and expectations are probably hitting a low here. So we took some money off the table. We put it in cash. We're trying to figure out what to do right now, where we're going to put it, and we're really, quite frankly, not sure. But at least cash pays us something these days. You know, until last year or so, if you sold something, you had cash on hand, you had to figure out something to do with it quick because you weren't making anything on it. So.
Well, we probably don't need to talk a lot about credit spreads and about the yield curve. You've touched on that, and we've said for some time we don't see anything that indicates a recession is on the way. Do you have any brief comment, or do we just want to say here's where we are, still the same place?
I would just say this: credit spreads is the one that interests me. Look, the yield curve's not doing anything that's even interesting right now. It's flat. Is it going to invert? I don't know. Maybe, maybe not. That's not the important thing anyway, as we've talked about many times. We haven't seen any significant steepening. Short rates did pull back some. The 2-year note yield did pull back, but so did the 10 years. So ultimately, the yield curve didn't change all that much. And it didn't change significantly enough to really signal anything. But credit spreads did widen somewhat during this recent during the fourth quarter, based primarily on shale. It was oil company debt that was mostly getting sold. But you only went up a couple hundred basis points. It's not even close to what it was in 2015 and 16. And by the way, we already got back half of it already. Junk bonds rallied. So, there's really nothing there. There's just not any stress there.
Well, let's talk about a couple more things today. One being the dollar. You indicated a little bit there. It just keeps moving around that same range. But then we're also looking at the dollar and the British pound and Brexit, and pull all of that together for me.
Oh, wow. That's a big bite. Well, let's just say that the dollar it appears to me to have peaked, but we have not gotten into a significant downtrend yet. I will say there was an article in the Wall Street Journal last Friday speculating that the Fed was going to stop the shrinking of its balance sheet, what we were talking about before. I don't think any expectation that they were going to shrink the balance sheet in a few years right back to where it was just foolish anyway. I don't think they'll be able to do it in anything less than the amount of time it took previously. But anyway, there's this article basically said, the Fed's talking about how they can truncate this and maybe end their balance sheet shrinkage. And the immediate reaction in the market was for the dollar to sell off, gold to go up, and interest rates to go up. Well, that's a classic inflation signal from the market. The market is saying if you don't shrink the balance sheet, that's inflationary. Well, again, theory and practice. Theory says that the Fed could expand its balance sheet, and as long as the public thinks it's temporary, not inflationary. Okay. I said at the very beginning of QE that when they reached the point where people figured out it was permanent, that would be when the inflation started to kick in. Well, if that Wall Street Journal article was true, then I think we've reached that point. But it's not going to happen overnight. It's not going to happen quickly. This is a long-term secular change. We're talking about decades where we might see, assuming I'm right about that it takes them that long to shrink the balance sheet, then we're talking about decades of rising inflation and rising rates. Doesn't mean it's going to be overnight. Doesn't mean it's going to be hugely dramatic. We went through the 50s and 60s without significant inflation. It was higher than it had been in the 40s and 30s, obviously, but it took until the 70s before it really took off and caused real damage. So I'm just talking about higher, rates trending. The pound, I'm a big believer in sentiment. And I was taught a long time ago when I first got in this business that whatever everybody's worried about, don't even put that on your radar because it's already in the market. I am of the opinion, and it's just an opinion, that whatever happens with Brexit, the pound's going higher because everybody thinks it's going lower. I don't know what they're ultimately going to do. I have said, and I'm kind of on record as saying that they'd probably be better off out of the EU than in it, assuming that they have some type of trade agreement, because the EU costs the UK a lot of money. They have to pay a lot in, and I don't think they're getting as much back as they're putting in. But I don't think it matters. Like I said, the sentiment is so negative on the pound, it's probably a buy. Look, we don't trade currencies here. It's not really what we do, but we do think about currencies because it impacts a lot of different things around the world. The impact of Brexit on the euro is just as important to us as its impact on the pound. And again, that's all affected by what the Fed does too. So what is the dollar going to do? I still think it's probably headed lower, but it really hasn't gotten into gear yet and moved in that direction. We're just going sideways. I do think, though, let me just add this one piece. The thing that's interesting to me is that gold keeps going up. Today we hit, I believe, 1315 on gold. And we have basically been rising now for several months where gold just keeps going up. To me, that's probably a tell. That means to me gold is anticipating the drop in the dollar. Markets anticipate, and gold's no different. So we shall see how that comes out, but that's my guess. We'll see.
Well, that is a perfect segue into the last thing today to talk about commodities. So we know about gold. What about the others?
Well, commodities took a hit in the fourth quarter along with stocks. That was a drop in inflation expectations driven primarily by oil. We're starting to see some of those things start to come back. When we look at the copper to gold ratio, it looks to me like it's stretched as far as it's going to go, but I don't know that for sure yet. If you look at the copper to gold ratio, it's very coincident with interest rates. When copper to gold ratio is falling, interest rates tend to fall. When copper to gold ratio goes up, interest rates tend to go up. We don't have really anything yet that says it's ready to turn and scream higher, but it does seem like it's probably gone down about as far as it can go. But with gold going up the way it is, I don't know. That's going to be very interesting to see how all that comes out.
Well, good conversation today, and I know you'll keep an eye on that. Any last comments before we wrap it up?
No, that's all I got. The only thing I would just say is don't ever think that whatever's going on today hadn't happened before, because it probably has. And there's an old saying about history that if you don't know history, you're doomed to repeat it. Well, as I said when we were talking before the thing, I said, I don't know if it's the education system or what, but people don't seem to know history anymore. I think they'd be wise to read up on it a little bit, because there's nothing new under the sun.
Well, by the time it's all over, we will be wrinkled little old money guys.
I think I'm getting there already.
All right. Thanks, Joe. And if you'd like to read the entire report, there's a lot more information in it. Here's the link, and we'll be back with our March report. So we'll talk to you then.